All right, we are live. Hi, everyone. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm the latest stock market moves. Nice to see you, Bob.
Hi, Katie. How you doing?
I'm doing well. So lots to talk about today. The S&P 500 is down another 3% this week. At one point, it was almost 20% off its recent record high in January. So what's driving this market sell-off, Bob?
Yeah, and we're almost down 20% today. And by the way, there's a lot of discussion that 20% constitutes a bear market, and a lot of these are these are conventions that we use. I wouldn't get too hung up on labels. The fact is that the stock market's having a very tough time, and there's a confluence of three things happening, three separate issues that are happening. Number one, the Federal Reserve is engaged in a big battle to bring down inflation, which was primarily caused initially by the COVID epidemic. And number two, we've got this Russia-Ukraine war, which is threatening the European economy and also threatening global commodities. So wheat and corn and even oil have gotten kind of caught up in this. And finally, people don't pay much attention to this in the United States, but there have been big COVID lockdowns in China. They've essentially shut down Shanghai for weeks now. They're starting to reopen it. Beijing has avoided May, because they have a very severe policy, zero COVID policy, which is remarkable. I don't know how they're going to enforce this, but China's the biggest consumer of commodities in the world. If you slow the Chinese economy down, you slow commodities down, for example, and that's going to have an impact on all sorts of commodities around the world. So any one of these three, the Fed, the Russia-Ukraine war, COVID lockdowns in China would have been influential. Put them all three together, and it's little wonder the stock market's having a hard time. If you had to pick one, the most important thing is what's going on with the Federal Reserve and fighting inflation. High inflation, moderate inflation is fine, 2 or 3%. Markets can usually handle it. People can handle it. Corporations can raise prices modestly. But when you get more aggressive inflation, and the CPI has been 8%, recently, year over year. That's the consumer price index. When you get levels that high, it eats into savings. It makes borrowing more expensive down the road, particularly for the Federal Reserve. They're big borrowers. If their cost of borrowing goes up, that's a problem. So the Fed's been trying to raise rates. The way you stop inflation is you have demand destruction. The Fed has a very blunt instrument. It can control a little bit on the money supply, and then it starts raising rates to slow the economy down. And that kind of creates some lessening of demand. The problem here is that it's a blunt instrument. It's very hard for the Federal Reserve to fine-tune things. You might hear this word soft landing. Can they raise rates just enough to slow the economy without throwing it into a recession? In the past, it's been difficult. They have thrown the economy into recessions. These are often, Fed raising rates aggressively is often associated with recessions. So that's why the market's a little bit freaked out about this whole thing. They're not sure the Fed can engineer a soft landing. So it's a very tough situation for the markets right now, dealing with three separate issues at the same time.
So, Bob, I want to kind of focus on a couple of stocks in particular. Target and Walmart are down big this week. What happened to their earnings?
Well, the simple story is this goes to this inflation story. Just broadly, the costs were a lot higher than they thought. So think about a company's reports. It's basically a top line and a bottom line. The top line is how much money did we pull in? It's usually called revenues. The total value of all the goods and services, all of the stuff that we sold. And so you have the top line. And then everything else in between is all the costs. It includes the cost of goods sold. It includes employment, labor costs. Then below that level, you have to pay taxes, for example. And then you have a profit, at the bottom. So there's the revenues at the top, all of the costs of your product, and then your profits. And what we're seeing for a lot of these companies is sales are still pretty good. By and large, the consumer's still spending, sales are good. However, they're encountering much higher costs than they thought. So, for example, much higher costs to ship things. Transportation costs are higher raw material costs than they anticipated. And in some cases, even higher labor costs. So you put those three things together, and you might still have strong revenues, but on the bottom line, you have less profits. So what's called the margin, which is your profit margin, shrinks. And investors don't like that. So that's simply put what the problem has been. This week, the retailers are basically reporting a lot of problems with the costs that are higher than anyone anticipated. This fuels this whole ongoing inflation debate. Now, there's some other subtler things going on. So if you look at Walmart, Walmart tends to have lower income consumers, lower middle income consumers. What you see, and Target to a certain extent does too. What you see here is an emphasis on food and beverages because the costs are higher, and some lessening of spending on discretionary items. So for example, Target came out and said, we're still seeing people spending on food and beverages strong, little less on discretionary items like televisions. Then you have some weird things going on. So for example, very popular items right now at Target, luggage. Luggage sales were up 50%. Sunscreen sales were up. This suggests people are traveling a lot, right? That makes sense. Everybody knows the airlines are full, the hotels are full. People are traveling a lot. So I think that's a very good idea. And I'm not surprised. People want to go out more, and they're pent up and tired of being pent up. So I think that's a very good sign, but we're still trying to figure out exactly where the costs are. And that's the big issue. How do you keep inflation under control at this point? And where can you get it under control?
So, Bob, another thing that we had some questions about is, has the stock market reached a bottom? And can you kind of talk about how we would know if we were at a bottom?
Well, it's really too soon to say. What you want to do is, the Federal Reserve, Jay Powell has said exactly what he wants. The Federal Reserve is going to keep raising interest rates to try to slow down the economy. When will they stop? Well, he said when we see signs that inflation is more under control, consistent signs. So you might have the consumer price index slowly coming down, but it's got to be coming down on a regular basis and consistently. So that implies the Fed isn't going to stop just because we get one, inflation report that's lower than the month before inflation report. So what you want to watch for is, if we assume that the equation here is we have high inflation, the secret to high inflation is slow demand down. You want to do is look for signs of demand slowing down. So look for slowing down and the signs of slowing down in the economy. Netflix a month ago talked about peak streaming. They basically said we're having trouble getting new subscribers. So that which makes sense. I mean, how many more new subscribers are there in the world? We're going to pay for streaming services. So everybody started using the phrase peak streaming. So watch for signs of things like peak travel. Watch for signs late in the summer, and I think this is probably going to happen. People are going to satiate their need to go out and travel. By September, October, you'll probably see slower travel demand. Look for signs of slower job growth. We all know job growth has been amazing. Jay Powell, the head of the Federal Reserve, has been astonished at how tight the labor market is. The number of people quitting, the number of people, the number of applicants per jobs available. There's more jobs than applicants out there. Look for signs of fewer people quitting their job, for example. If you want to look for another issue, I'll tell you a simple thing to look at, that I look at, is oil. What is oil? Well, I mean, it's one of the world's most traded commodities, but in the instance that we're talking about here, oil is kind of a proxy for global demand. It's a proxy for inflation. It's not a perfect proxy, but trust me, when I look at oil every day, when I see oil going down consistently, to me, that would be a good sign that inflation is improving. Inflation is getting lower. Demand's getting lower. I don't see it. Oil's been over $100 for a while. It's 110, 112. We had JP Morgan's chief of commodity analyst on, thinks it could go to 125. That implies gasoline, for example, will be consistently close to $5 all throughout the summer. That's high. And eventually that will lead to some demand destruction, I'm sure, particularly if it gets notably over $5. If you're wondering what is going to change that, well, the Ukraine war is a problem, and that's an issue for global supplies. There's all sorts of stuff, moving around because of these sanctions, and it's not clear how that's going to play out. But for the moment, we have more demand than supply, and that means higher prices. So if you want a good rough proxy for how inflation is doing, just watch the price of oil, and I think that'll serve you well.
So, Bob, we've talked about a lot of issues facing investors in the stock market right now. Are there any parts of the stock market that are still strong?
Yeah, energy stocks have been consistently strong. ExxonMobil's at a new high today. Who would have thought, 2 years ago, they would have laughed at you. But energy has remained, it's the one consistent outperformer this year. The problem is, not many people have ever owned energy stocks. People stopped caring about them for years as they drifted south. Energy was only 3% of the S&P 500. That's a pretty small. It's 11 sectors in the S&P. Energy's 3%. That's like nothing. If you own an S&P 500 index fund or an S&P 500 ETF, it's 3% of what you own. So energy's been under-owned for a long, long time. It's doing well. It's holding up. The other group holding up pretty well was pharmaceutical stocks, and I mean big pharmaceutical stocks. Lilly, Merck was at a new high. Bristol Myers, Johnson & Johnson. These stocks are just a few percentage points below their recent 52-week highs. Why? Well, you kind of hide out in them because they're consistent outperformers. Now, here's the problem with that. They're safe because people always have to have pharmaceuticals and they're not going away. Well, theoretically, yes. But they said that about consumer staple stocks. They said that about Clorox, and they said that about food stocks, and they said that about Walmart, right? People always got to go to Walmart and buy things. Well, it turns out that that's true, but if Walmart suddenly has problems with their profit margins and Target suddenly has problems with their profit margins, that means people are going to, a lot of investors are going to be willing to pay much less for Walmart or Target, because the way these stocks are valued, they're valued they're valued on two things: whether their earnings are growing or shrinking, and how much are they growing, what they call the delta, and also on the multiple. The multiple is how much are you willing to pay for this future stream of earnings. So maybe it's got a stock that's trading at $10 and it's estimated to make $1 in earnings in the next year. Okay, so you're paying 10 times a future stream of earnings. $10 stock, and you've got a $1 profit for the year, earnings profit, plus a little bit of a dividend maybe. So you're paying 10 times forward earnings. Now, if that profit estimate suddenly changes, instead of $1, you're going to get $1.20, and that stock still stays at $10, well, good for you. You're getting more for your money. However, if there's a situation where the profit margins come under attack, not only could the earnings go down, the willingness of people to pay 10 times forward earnings may change. They may say, I'm not going to do that. I'm only going to pay 8 times forward earnings. So the multiple contracts. So there's two aspects of this here. First is the earnings, the absolute dollar value of the earnings compared to the price. And is that going up or down? How is that changing? And the second is, how much are you willing to pay for that $1, no matter what? Maybe you're only willing to pay 8 times rather than 10 times. That changes. And what influences that multiple is, first off, the overall situation in the economy. When the economy is expanding, people are willing to pay more for these stocks. And number two, interest rates. Interest rates compete with the stock market. So if we're getting 1% yield on a 10-year treasury note, a year ago, and now we're getting 3%, well, for some people, a 3% return that's guaranteed might be very attractive against the casino that's the stock market. So stocks compete with bonds for investor interest. And as interest rates have been rising, there are some people who are starting to find bonds perhaps more attractive. So remember that. Stocks always compete with bonds for investor attention. Why would I, if I don't think the stock market is going to do anything this year, why wouldn't I buy, 2-year treasuries at 2.75%, which is guaranteed, versus the stock market where I think it might go down this year? So people make those kinds of decisions. They're more sophisticated than I told you about, but that's basically it all the time. And that's what's going to be very tough about it. But I'm being a little long-winded here. Energy and pharma is still very strong this year. And there are bears out there who will say, to have a real bear market, you're going to have to sell off energy and pharmaceuticals too. Why? Because in a real bear market, everything goes down. Everything just drops because people just kind of walk away, and marginal investors put money in cash and take it out of the stock market. I don't know about that, and I don't know if we're going into recessions at all. I don't know. I'm neutral on that at all. I know that energy and pharmaceuticals have continued to hold up very well.
That's great insight, Bob, and I'm sure it's helpful for a lot of people, when there's so much going on, to look at those two bright spots, I guess, in the market. And you mentioned recession. There's been some chatter. Are we getting a recession in the future? Who knows? But how can investors position themselves for a potential recession?
Well, you and I have talked about this before. The problem I have is with the word position. The word position implies that you can somehow do some kind of magical market timing that says, okay, in February, I'm going to take money out of the stock market, and then in July, I'm going to put money back in. That's called market timing. The one thing I can tell you, having been here for 32 years and spent a lot of time with market historians, is market timing does not work. You think you know, you don't. And professionals don't know either. If you listen to CNBC, listen to the long-term investment professionals who come on, not people who are day trading or encouraging people to day trade, but listen to the long-term professionals who come on to tell you that the important thing is to understand your own risk profile. That means, how much tolerance do you have for volatility in the markets, and how old are you? I'm going to tell you, if you're 30 years old or 40 years old, you should have a regular investment plan to put money into the stock market on a regular basis. And believe me, 10 years from now, what happens this year is not going to matter to you. It won't. It's time in the market, not market timing. This is the old phrase they use that really matters. So if you consistently put money in and you're young for a long term, and I'm talking decades, that's the way to wealth. If you think that you know exactly when to go in and out of the market, you don't. You should look up some of these numbers, but there are very classic studies that show what happened to people on their 10 days, the 10 most important days when the market's up in a year versus 10 down days. And if you're not in the market on the 10 days that matter the most, your returns are way, way below the market returns. Nobody knows when those 10 days are. And by the way, you could do the 10 most important days over 10 years. It doesn't matter. Nobody knows when those days are. Nobody. So I wouldn't worry about whether the market's going to be down this year. I think there's a good probability it will be. If you were young, I would have a much longer term look on the market. Now, if you're a lot older, if you're 70, I'm picking a number, and you have 75% or 80% in the stock market, you might want to consider how your risk profile looks and how comfortable you are with owning stocks. Even if you're 70, though, I would simply point out something. The probability is very high that you're going to live to 90 if you've made it to 70. That's another 20 years. Consider that. I know that seems like a long time, but you think you're 70, you're going to die in 2 years. Probably not. Probably not. The probability that you'll make it to 90 is much higher than you'll die at 72. So I know it's hard to sort of think longer term in many years, but I think that's probably the best way to look at things. Now, if you have the opinion that, well, the stock market now is going to be like, the 2000s, and we're really not going to have any gains for the next 6, 7, 8 years because we've had outside gains for the last 10. Okay, that's a position. You can have that. it's possible, but in the long-term periods, and I'm talking about more than 10-year periods, the stock market has never been down. It has been down for several years and periods, but never for really long terms. Historically, the S&P 500 is up 3 out of 4 years since the 1920s. 3 out of 4 years, and the average gain, including the dividend, is close to 10%. Now, we've had outside gains for the last 12 years, and maybe we're going to have substandard gains for the next several years, and maybe even a down year this year. That's quite possible. I don't know. I do believe in the country. I do believe in capitalism. Sorry to get on my soap opera, but I do believe that capitalism produces long-term gains in the markets because of the way it's structured, the way it's set up. And that's my position. And I can tell you, I'm a pretty old guy, and I have substantial money in boring ETFs that track the stock market, like the S&P 500, and haven't really changed that position, even though I personally think there's a good probability this will be a down year. I accept that fact as an investor. So again, understand your risk profile. What are you comfortable with? How much volatility can you take? Take a longer term view than just the year in front of you. Understand the historical development of the stock market, and adjust your investments accordingly.
Yeah, boring can be a good thing when it comes to investing, right? And I think it's especially important to remind people about that long-term mentality.
Investing is boring. I know people are trying to turn it into a casino. I know now that you can sit in a bar in Atlantic City with your boyfriend or your girlfriend, and you could have DraftKings on your one phone, and you can have Robinhood or some other investing app on your other phone, and you can bet on the game this weekend, and you can bet on IBM on the other phone, and it's like the same thing, because both of them are like sitting there like gambling, because they issue the same brain chemicals go off in your brain that make you excited. IBM's up $1 today. Look, honey, I just made $1,000. And the Jets are going to win here, and I made $1,000. The same brain chemicals go off, but it's not the same thing. Betting on the Jets game is not the same as betting on IBM short term. It's not. The stock market is not a casino. In a casino, by definition, you will lose money over time. You have to, because it's mathematically set up. Walk into a casino, play craps for 3 weeks, I guarantee you're going to lose money. It has to happen. It's set up that way. It's mathematically set up. The entire thing is set up. In the stock market, you may lose money that day or the next day, but mathematically, longer term, the stock market goes up. So the stock market is the opposite of a casino. In a casino, mathematically, long term, you are designed to lose money. In the stock market, mathematically, historically, market has gone up. On either day, you might be down on both of them, but long term, people need to understand when they say, oh, the stock market's a casino. Yeah, nice metaphor, but it's not true. It's not true in the long term.
Yeah, exactly. And especially with all of the recent volatility we've seen, it can be easy for people to feel those jitters in the market. But yeah, it's important to remember to keep a long-term mindset. So Bob, our last question today is SEC Chair Gary Gensler testified on Capitol Hill. Can you tell us a little bit about what we learned?
Well, Gary Gensler is quite a remarkable man. I've been covering the SEC for 25 years, and I've never seen activism like this. By activism, I mean he is flooding the market with new regulations, proposed regulations, I should say. So I'll give you an example. The most controversial one is on climate change. He wants a lot more disclosure from corporate America on climate change, what they're seeing, what they're doing about it. And he's starting to get a lot of pushback from people who are, number one, corporate America, who are overwhelmed by these regulations. He has 50 proposals out for all sorts of things. I'm just bringing climate change up on one of them, but all sorts of things that are going to require a lot more disclosure from corporate America. and they're a little overwhelmed by it. And Republicans are coming out in some of these, like the climate disclosure, and saying, wait a minute, this is not even in the SEC's purview to ask about climate change. And Gensler is saying, oh yeah, it is, because investors want to know about it. So it's actually very interesting and controversial. But the point is, he's the most active SEC chairman, I mean, at least since Arthur Levitt in the 1990s. That's as far as my memory goes back. And he went to Congress this week to testify. These are routine hearings, budgetary hearings, to ask for more money, specifically for the Enforcement Division. He basically said, there's a lot of bad guys out there, and we want to go after them, and we want more money to go after them. And that's a good thing. You want the SEC. The SEC was set up in the 1930s to provide investor protection against fraudsters and scamsters. And believe me, there are fraudsters and scamsters out there. But he's getting a lot of blowback because of all of these regulations that he wants. He's getting a lot of blowback from the crypto community. He's kept saying he's opposed to a Bitcoin ETF because there's not enough protections around these exchanges. And if you saw the blow up that happened in the stable coins in the last few weeks, believe me, Gensler has some protection here, because I guarantee you that really hurt the crypto cause there, that blowing up. And heaven knows, I'm quite sure the SEC is looking into this to figure out how that could have possibly happened. And it only makes it more difficult for crypto to gain broader regulatory acceptance. Gensler's already said he's looking into it. So I think there's a lot about Gary Gensler that I think is very interesting. He gets a lot of blowback for this climate disclosure thing, but his position has been, the corporations themselves are doing this, and people want to know. And all I'm trying to do is introduce a structure around telling people, well, here's what you ought to tell us, and not, rather than this nothing catch can, no regulations that we have now are. So it's a very interesting regulatory question about what is the extent of the SEC's powers, and can they sort of create new laws and regulations, by fiat like this? The answer is yes. They have certain powers that were granted by Congress, but you can engage in what's called regulatory overreach. And some of these climate change ones are quite controversial. So I haven't spent this much time covering the SEC in 20 years. It's exhausting covering Gary Gensler every day. There's like a new speech every day that he has. And you read it again and say, oh boy, another speech from Gary Gensler. But he's quite a remarkable guy, very ambitious. So we'll see how much he gets through this year. There's a whole bunch of hearings scheduled, and maybe he won't get as much done as possible. But his ambition levels are very high.
Yeah, for sure. It's definitely been interesting to watch and see what he's done with the role. Bob, before we go, I just have to ask, because I know our audience is interested, have you added any new posters to your collection recently?
Yeah, I bought an AC/DC poster, and AC/DC. There's a very famous AC/DC poster from 1979. It was a tour they were doing, and there's a German version of the poster. I don't have it in front of me, unfortunately, but it's sort of the most famous AC/DC poster, and it's very cool. And I bought one that was the German tour version of it. That's really rare. These bands did tours in Germany, and there were posters made for that, and they were hung in subways and marquees and theaters and things. It's just very few of them because they were done on thin stock, and they're big. They're like 3 feet. So people threw them away. Nobody saved any of this stuff. There might have been 200 of them made, and nobody saved them because nobody thought they were art. They were ephemera. So it's really hard. There might be like a half a dozen copies in existence. So I bought one of those, and I bought a Queen tour with Freddie Mercury and his most outrageous self on the poster, and it's kind of cool.
Yeah, that's awesome.
It's a wonderful hobby. I have to say, I show it to people, and they just go, "Wow, that's really cool."
Yeah. Well, I think that's one of the great things about that came out of us working from home is we were all introduced to your poster collection. So
yeah.
It's been great to see.
Well, I still have behind me is an old Led Zeppelin poster. That is actually, let me see if I see that one right Yeah. These are the two, that poster on the left there, that's really the first Led Zeppelin tour. In 1969, they went to the Fillmore in San Francisco. Bill Graham ran the Fillmore. And the first album had not come out, which is one of probably the greatest blues rock album ever. It has Communication Breakdown on it. And they were so new that Country Joe and the Fish, who was a hippie band in San Francisco, very famous, actually was the headline act. Led Zeppelin was opened for them, and Taj Mahal, who was appearing was appearing in Woodstock a few months later, actually opened. So Led Zeppelin opened for Country Joe and the Fish in 1969. This was January 69. By the middle of the year, the album had come out, Led Zeppelin 1. They were famous. And you can see behind me, this light blocking you, but this is the famous picture of the Zeppelin behind the picture. There's an advertisement for the Rolling Stones below it, who was about to appear at an infamous concert called Altamont, which was a disaster and probably the end of the 60s. But these are the two first Led Zeppelin concerts on their tour. One was in January and the other was in, I believe it was June of 69. June 69 was just before Woodstock. So to me, these people are psychedelic masters, and psychedelia had a very big impact on the visual arts in the 60s. And you can still see it, the visual impact today. You can still see posters and advertising that utilizes the twisted block lettering of psychedelia. I call it neo-psychedelia. When people try to imitate these styles from the 1960s. But most of these posters had runs of about 2,000, were given out at the shows, and most people tack them on the walls and threw them away. So in some cases, only a few dozen copies might be in existence. So it's kind of a fun hobby. There's only a few that collect them. So it's not like there's this massive demand for these things. It's a pretty obscure hobby, which is why I like it.
Yeah, and I know that our audience loves hearing about it. So thanks for sharing that. And thank you for another great week of Market Matters. Thanks for answering all of our questions.
Thank you. Always good questions, guys. You always have the right questions.
Yeah, for sure. So thank you again, and we'll talk to everyone in a few weeks.
See you guys. Take care. Bye.